Well, welcome back to the iWealth podcast. Quarter one is over in the books in 2026, guys, and it was one for the record books. We'll talk about some numbers and stuff coming up, but ultimately, we're here to help our clients. It's pretty easy to look good when the market's up 18% and sit in front of clients and show them their returns. And when it's down, it's not as easy. But it's also why clients pay us to take care of their things and to take care of their issues and help them with their goals and all the other kind of stuff. So let's put into context kind of where our heads are at with what's going on with this market, what has happened, what do we think could happen in the future. But Sean, just start us out with some numbers and then we'll go to JP. Like, what are a couple of numbers that stood out to you in this first quarter of 2026?
Yeah, what stood out to me was what appears to be more dramatic up and downs from a daily basis, and I think the struggle is that the news is going to constantly give us those indexes that get our heartbeat to go up. Some days it's the positive heartbeat, get us excited, and other days it's a negative headline. We did hit correction territory in a few of the indexes.
What is that? What's correction territory?
So we hit a high. We hit a high in January, and then we fell 10%
So
in
10%.
those indexes, 10% drop.
Yeah, yeah.
That didn't mean that we were necessarily negative yet. It just dropped 10% from that high. So one of the things that I thought was interesting was this was kind of the return of the 60/40 portfolio. That if we were all equity, maybe we were experiencing a little more of that drop. But if we were diversified, I had a lot of clients that we were looking through their performance reports and we were positive through the whole thing.
Hmm. Yeah, surprisingly.
It really depended on the mix of the holdings,
Right.
and diversity won.
Yeah, yeah. What are some numbers that stood out to you, JP, when you kind of recapped what's going on?
Yeah, and I think this goes back to what we talked about in quarter four coming into this year. We expected that term that Sean used, diversity, to kind of win. So a lot of the downturn was in those mega cap stocks. Taking a look at when Sean says we're looking at clients' portfolios, we're not 100% invested in one index or the other.
Right.
Typically have a broad basket. And we saw outperformance in value stocks, which again we expected coming into this year.
So one second, how would you explain it quickly, a value stock?
Yeah, we explain it as a big old and good stock. Companies that have been around a long time, where their earnings are very stable and they're typically making money. They're not companies who are spending all of their money, reinvesting back into themselves. They're making earnings and they're paying those earnings out to their investors in form or something like that.
So those stocks did better.
Yeah,
Q1.
yeah. I mean, from a number standpoint, I looked this morning, Russell 1000 growth was down 9% as of Monday. Russell value was up 2.93%.
Mm-hmm.
And and small cap stocks were another positive, up. Russell 2000 was up 2.26. So again, kind of what we expected after this long run of constant growth outperformance.
It's what stood out to me was the S&P 500. So most people know the S&P 500 is 500 large company United States stocks. I've been talking about it for almost 2 years with clients. If they're in a 401k or something and they have an S&P 500 fund that's not equally weighted. Like if you just buy the S&P or you just watch the S&P ticker on TV, you're seeing something that's heavily overweighted to technology stocks more so than ever in our lifetime. And so those did very, very well last year. I was wrong last year. Those stocks did well and it made the S&P run up. There's also the equally weighted S&P 500. So it's 500 stocks equally weighted. It was still up last year, but it wasn't up as much because it wasn't all in these technology stocks. Well, first quarter, if you just look at how's the S&P doing, the S&P is down 4%. The equally weighted is up 5%. So had you heeded the advice and got out of the normal S&P and got into the equally weighted, you are well rewarded for the first year because of those value stocks and things to your point. So it's just interesting because for the lay person out there, investor, and they shouldn't necessarily, unless they do research, understand that the S&P 500 is not just an equally weighted index. Most of the people are using one that's not. And then the other thing that stood out was Bitcoin. Like Bitcoin was down 23% in the first quarter of last year. So Sean's talking about market volatility. AP's talking about value stocks. I'm talking about equally weighted versus regular. I mean, it just was a super interesting quarter. What are you thinking about oil right now? What are you guys thinking about that?
I had joked with my wife when gas was $2.38 that I wanted to sell it all, sell everything, and buy tanker trucks
Full of gas?
full of gas because I just didn't believe that that was a real a real price. It just felt like that was too low.
Mm.
And now with the world events that are going on, it seems like an incredible shock to us. I'm glad we don't live in some states that are probably at $6 a gallon.
Right.
But we look at what the effect is going to be. Is it going to stop anybody right now? Very few people are going to adjust their course of action because of what's going on.
Depends on how long it's going to.
Correct. Yeah, we've got such a resiliency in our U.S. economy and our personal pocketbooks to ignore, things like that and just keep spending. And I think the U.S. economy probably does pretty good during this all, but it feels different, and it's not. We've gone through high energy oil prices before. I think the headlines of the day are dictating some of this stuff. Nothing changed overnight, and all of a sudden gas prices change.
Right. Right. Isn't
You
it
know,
interesting?
the supply didn't change,
Yeah.
the demand didn't
Yeah.
change.
Yeah.
It's
Yeah.
yeah.
JP, how do you play this then as an investor? How do you think about oil if you're a long-term investor? Do you just ignore what's going on? Is there investments that are making a bet in oil? Like how do you think about that from an investor standpoint? What should they be thinking about?
Yeah, I mean, and again, just I feel like a broken record. It goes back to diversification. You should own some energy. You shouldn't be 100% invested in energy, but you've definitely benefited if you own energy stocks and things like that, just based on the fact that prices are higher and they're able to sell it. It also comes back to stick to your plan. We've talked about this volatility, and it's so important that when we do see these spikes in gas prices and things like that you know we're still at a point where we don't think that this is going to be a sustained, oil is going to be over $100 a barrel. And we see when, as soon as someone gets on the news and says we've reached a peace deal, and all of a sudden oil drops below $100, the market reacts with a
Yeah.
3% swing or 2.5 point swing.
But
If
not
you're
one ship had moved
exactly
a step forward. Nothing had
exactly
changed.
Speculation.
Just speculation.
And if you're trying to time that, good luck.
Right. Right.
Good luck
Yeah.
if you're trying to time when they're going to get on the TV and say, yep, we reached this peace deal.
Yeah.
And if you're trying to time it and you miss it, you just missed out on 2.5 yesterday. And then now today, oil jumps back above $100. So you have to make a plan that's right for you.
Right.
And you need to have discipline in sticking to that plan.
How do you, John, how do you pivot and think about international stocks? They outperformed US stocks last year.
hmm
And then all of a sudden we have a war. It's not in the United States, but we're part of it, over in Iran or started it, however you want to say it. How do you think about coaching a client around their international portfolio?
Similar to what JP said, I think we've got to keep our plan in perspective. And right now, if we look at the valuations of those companies and things like that, they still look like they are on sale compared to our stock market. If we look, international versus the S&P,
Price to earnings.
price to earnings,
How
right? So
expensive
how
the
much,
company
yeah,
is.
how much would I pay that company if I could buy it? And when would I get my money back based on the earnings of the company? And, if we look at the international stuff, it still looks very attractive compared to ours. But even still, if we look at like the S&P and the amount of tech that's inside of it, we've got to remember that only 20% of the US companies have adopted AI at this point. People are using some of it, but they haven't really adopted. They haven't really started spending the money to build it out in their systems and what that's going to affect. So, international is a component. We went 10 years where our markets just beat the holy heck out of their markets.
Right.
You look kind of dumb if you had your 5 or 10% in international because it was kind of a boat anchor. And then things are starting to come back around to some normalcy.
Yeah.
And it needs to be 20, 30%.
Yeah. I forget who said this, and maybe you guys will know, but the four most dangerous words in investing is it's different this time. So, when it comes to international investments, when it comes to oil, like just because this is happening right now, Israel and all the stuff happening, like if you could just step back and let cooler heads prevail and make sure you're diversified, that's the key
Yeah.
component versus trying to make a decision based upon hey, we went and bombed them and now we're at war, so I'm going to make a bunch of decisions. But speaking of decisions, if somebody walked in here today and said, JP, I've got $300,000, what should I do with it? What questions are you asking and how are you thinking about it with the way this market's acting?
Yeah, biggest question is what's it for and when, and the risk tolerance, right? I mean, that's a huge factor into things. Sean talked about the return to the 60/40. I mean, income and bond income has gone up, yields have gone up, and that's very attractive right now.
And more stable.
Exactly. So as we look out and if there's short-term goals, that's really attractive to have more of that bond yield income that is, like you said, more stable compared to we don't know what's going to happen with stocks in the short term. Are these oil prices going to drag on? We don't think so, but I can't guarantee that happens. Control over
Right.
how much we bond them or things like that. But those are the big things. When do you need it? What's your risk tolerance? And again, looking at how the safer investments are starting to look more and more attractive by the day.
Yeah.
Brad, you had said, when the markets are constantly going up, it's pretty easy to look good. We've always used goal-based investing. I since the day I started here and working with you, the idea of bucketing things out and having names for things keeps you emotionally in control, so that if I've got an account that is my travel bucket, my leisure and my fun thing, and if I've got some cash in the money market in that because I thought I was going to go on a trip this year, the fluctuations in the market do not matter to my trip. I've got time to outweigh this stuff.
Hmm.
And I think we've got to just keep that in perspective. JP, you hit the nail on the head. What is it for? Is it speculative money? Then go in today, push all in, and be done. If it's for a stated purpose, sometimes investments aren't the right thing, right?
Exactly.
Or that investment needs to be money market, or
Yeah.
it needs to be a CD or something like that. But we've got to keep our head about us in terms of the perspective.
Because I had this happen this week. And what we decided to do, this was money that was 3-year plus money. It was for growth. It's not to build a house or to retire in 3 years. So it was like opportunistic money. So we took half of it and put it in the market immediately. Looked like a hero yesterday because the market was up. But what about tomorrow? Nobody knows. And then we're going to dollar cost average in over the next 6 months, the other 50%. This is the playbook for it. It's really a gut check. It's a feel. Can your client handle some more volatility if they put $150,000 in and it's worth 120 2 weeks from now? Are they okay with that? Or it could be the other way. I think that's something to think about. And then the other thing I think that people need to think about is when do you need money? So back to your goal-based accounts or those bucket approaches, I think I've been having a lot more conversations with clients about if it's money you're going to need in the next 18 months, should we be getting more conservative right now? Have you guys been talking about that with your clients?
Yeah. For sure, I'd rather be able to tell you your 100,000 is worth 100,000 18 months from now than saying, you know, we got a little greedy because we've had 3 years of really great growth and we wanted to keep it there and we were scared of missing out.
Yeah.
I think that's the biggest psychological thing. Like we need to educate clients on we might miss out. We might, but would you rather have your 100,000 still be 100,000 18 months from now or 110,000, something much more conservative than being all in?
Sean. So let's say that your client walks in and last year was up 10% in their 100,000. It's at 110. They're all in the S&P 500, which they wouldn't be with us, but they are. And now it's down 4%. So the 110 is down 4%. They need this money in 18 months to build a house that they want to build. How would you look at that and go through it?
I mean, there's two incredible emotions going on in there, right? The idea that when markets go down, they tend to go down faster than they seem to go. But if we stop and we take a look at what happens after major events, we look back all the way probably 20, 30 years ago. We look at every single major geopolitical event. And where is the market 30 days later, 6 months later, a year later? It's almost always. But in that person's case, what if it's not, right? What if it isn't? Can we say, look, we were ahead the last couple of years? We went from 100 to 120 to 150, and now we're back to 140. Awesome, right? We are closer to that goal. Let's move what we need to
Yeah.
now. I'm guessing that's not their last dollar, right? They've still got other money that's invested, but that goal, let's set it aside, take our win, right? Did we peel back a little bit in the last month or whatever? Yeah, but let's move ahead. That goal is now checked off.
Yeah.
It's back to our other retirement and our other income. And do we need to make a change? No.
Agree.
Most likely, we do not need to make a change.
All right. So, we outlined the fact that the markets were super volatile, that things went down, some things went up. We have no clue when this war is going to be done. So, what do you tell somebody that's looking at retirement or looking at that they're a little bit paralyzed? Like, what should I do with this market? What's the first kind of questions you guys think of? JP, I'll start with you and then go to Sean. Like, what do you think of when somebody comes in and puts their 401k in front of you and it's $1 million and they're 64 years old and they're saying, I'm a little paralyzed about what I should do with this market and I want to retire in the next, 18 months. What should I do? What questions or what's going through your head?
Yeah, well, I mean, hopefully it's not the first time I'm speaking with them 18 months before they're ready to make a move. But
Good point.
with this market, I truthfully not overly concerned with the volatility that we've seen, and I don't think it should scare someone out of making that move to retirement. Now, one of the biggest things is going to be, how much are you going to need out of that $1 million? So hopefully there's some plan around how we're going to replace that income in 18 months when you are ready to get done. But like we've talked about, a lot of the volatility is concentrated in those mega cap technology stocks. If you own only that, then yes, unfortunately, like you mentioned, you're down 4%. But that, I don't think you're at a spot where I would definitely make some adjustments to the portfolio. Again, like we talked about, you have to have a plan for that income. When you're going to retire, you can't have everything in stocks. Otherwise, you're always selling something that's down 4%. We need to be diversified so that we can sell a value stock that's up 2.93% as of the end of the quarter or something like that, rather than selling those stocks that are on sale, allowing those to reaccumulate over time. It's really that volatility, I think, is concentrated. There's this geopolitical conflict that's going on. We've talked about how those typically aren't long lasting on their impacts to the market. And earnings, one of the biggest things, earnings compared to 2022, expectations went up in quarter one. So although they're starting to talk about inflation, prices typically follow those earnings. And when this geopolitical risk starts to die down or become a norm, hopefully not, we're going to revert back to hopefully a positive market in 2026 would be my thought.
Sean, how would you, building on that, how would you address that with the client? Would you walk them through any scenarios? How would you think about it?
I think one of the things that we do really good is we really dig into what their needs are going to be and their timing. So I was just working with somebody who, maybe their savings levels are a little on that edge, right? If we were in these years that we've seen where everything grows, and I'd say, well, we'll be able to take out 18-20% of your portfolio and everything's going to be sunshine and roses and you should walk off your job today. We've always said that's just not realistic. We're not going to maybe follow the 4% rule, but we've really got to look at it and know and dig in and understand what their income needs are going to be, what those possible replacement sources. Can we delay Social Security? If times are great, maybe we can delay Social Security and get some longer term benefit.
Yeah.
But if we get closer and closer to that date and and something is struggling, well, then maybe we can turn that income source on earlier and take a little pressure off. We need to know all those components going into it.
Right.
And looking at it, this person said, well, what should my target be? What if do I have to get from here for 1,000? Then can I retire? And I said, well, the problem is maybe tomorrow you're there, but then on Monday when we wake up and the number's not there anymore, now what? Do you go crawling back into HR?
Right.
No,
Right.
you know, that means we're not there.
Need some cushion. Yeah.
We need some cushion. We
Yeah.
need, if we can't change expenses because we've dealt with, what are your bare minimum expenses and now what are your leisure and your add-on things? And if we're not there, we're not there. I
Yeah.
have no problem telling a prospective client or telling an existing client that we're just not at that point.
Well, and that's what's interesting about this conversation or this piece of this conversation is that AI is not going to do that either. Because AI doesn't know what to ask you to get to those outcomes.
Mhm.
So, I mean, that's the value of sitting down with an experienced individual or team or company that can kind of walk you through and ask you those questions and give you some honest feedback with it. JP, I like what you said. Like in my mind, if they need to have $50,000 a year out of that $1 million portfolio, then we got to take 100 grand a day and get it pretty conservative. So if they're ready to retire, at least if the market's down, we can, let that money rebound because we got the cash protected. So those kind of strategies and how do you do it and the tax efficient manners and all those kind of things is exactly what we do each and every day. So to finish this out, let's talk about going forward. What are some positive things? We've talked about the negative things that have gone on, the volatility, the market, that kind of thing. What are some positive things that you see on a go forward basis? Sean, a couple things that stick out to you that will help drive this market potentially.
I would say most of the economists that we follow do not believe that we are going into a recession.
Agree.
Um, you know, if oil prices stay high, will that affect the U.S. and put us into a recession? Probably globally, where they don't have the opportunity to just go open a spigot and get some more out of the ground. It's gonna make some of those economies struggle. But ours, we've kind of turned a corner. We're more service based. If gas price goes up, am I not going to go to McDonald's tomorrow and buy my lunch because I've got to rush back here? No, everything goes on. Our economy is very resilient. It just looks like that's going to continue. And I think, again, as long as we stay diversified and we stick to our plans and we don't either get greedy or scared,
Yeah.
we're good.
Yeah. Post pandemic, the people that have more money today than they did in the pandemic. So to your point, they're still going to be able to fill their tank up with gas and things like that. There's also the biggest tax cut coming. So the people are going to get more refunds in April of this year than ever in the history of the United States. That's got to be good for the market, right?
Yeah, I mean that plays right into the fact that the consumer is resilient. I mean that consumer spending stayed relatively steady throughout all of quarter one, and I feel like gas prices have been elevated for quite a few months here. So that plays right into that.
Yeah, yeah, for sure. What else on a look forward, go forward basis are you thinking about with this market?
Yeah, part of it I mentioned, the economists that we follow continue to talk about how earnings are really the driver of stock prices. And as I mentioned, Q1 earnings expectations went up instead of going down. Hand in hand with each other, if that continues and this geopolitical risk goes down, we should see positive returns by, the end of the year.
Yeah, yeah, yeah. It just all depends on what happens with this war. I agree with you, Sean. I think, if it got up to $150 a barrel and stayed there for 6 months, things might be a little different, but we're self-sufficient. I think cooler heads prevail. I just hope this thing is over. We're in this 2 weeks kind of the hold off period right now, we think, and I just hope this thing can end so that we can kind of try to get things back to normal. If that happens, there's so many tailwinds with AI and everything else going on, productivity gains, cash in the bank for people, tax refunds, that I think this economy continues to roll forward. And I think international is going to be just fine too. I think there's going to be certain sectors that are going to be hurt worse, especially with high oil and stuff like that. But ultimately, I think we're on pretty good footing. But hey, if you have any questions, just get a hold of Sean or JP or Gary or myself or anybody on the iWealth team, quite frankly. We're here to serve you and take care of things. But hopefully, this gives you some clarity on your day and let us know if you need anything and have a great day. Thanks, guys.
Thanks.